Welcome everyone to our second, I guess, episode of the Real Estate Roundtable, talking about Toronto and Vancouver housing markets with John Pasalis of Realosophy Realty here in Toronto and Steve Saretsky of Oakwin Realty in Vancouver. Hi guys.
Let's do it. Looking forward to round two. I think episode one was a decent success. It was some good feedback. So taking on from Jesse Bain's legacy.
Yes. So thanks for everyone's comments. We saw enough good ones to continue.
Yeah, barely.
There you go. So we're gonna go ahead. So wishing you guys a great Canada Day. Hope you had a great Canada Day weekend. And wanted to ask Steve, are you trying to create like housing thirst with your view from the perch out there? Your tweet on Canada Day?
That renovation cost me a lot of money, so I had to post it.
All right,
you gotta highlight Vancouver. You got to justify the prices somehow. So.
It looked like a beautiful outdoor space, so really nice.
Yeah, hopefully there's no towers that go up in front of me, but we'll get into that.
Great. So I'm going to just start there, maybe Steve, with your view, what's going on in Vancouver right now. I noticed that you did tweet again earlier on July 1st, actually on Canada Day, that Greater Vancouver home sales recorded their second weakest month of sales in June. The second weakest month in over 20 years. And you are noting that higher mortgage rates are slowing buyers in a big way. So tell us more about that.
Yeah, so I guess first off, maybe a slight correction. We had a little bit of data come in the last minute. So it ended up being like the fourth slowest June in 22 years. But it was like we had beat out like a couple of years with like 10 sales. So like just to put that in context, so it was a very weak month of June for Greater Vancouver home sales. Now, what I will say is, we've talked about on the show before, it was like most of the carnage and most of like the market's crashing and everybody run for the hills. Like most of that pain is still in the suburbs. So if you look at the Fraser Valley home sales, which is technically a different real estate board, but we're covering Langley, Surrey, Abbotsford, so in the far-flung suburbs there. It was a 22-year low for home sales in the Fraser Valley. It was actually the weakest June we've seen on record that I have going back 22 years. And so I think that's amazing because when you actually look at in the city of Vancouver here in the Metro Vancouver, where all the growth has been over the last 10, 15 years in terms of population growth and new housing supply being built, that's all been done in the suburbs in the Fraser Valley. So when you say, wow, we just had a 22 plus year low in home sales, that doesn't account the fact that, how much has the population grown over the last 15 to 20 years? How much has the housing stock grown over the last 15, 20 years? So this is an unprecedented slump in home sales in the Fraser Valley. And that's where we're seeing, again, most of the price declines as well.
And you noted the mortgage rates was one thing. I did see another tweet that I think you were talking about the first normal summer post-pandemic and whether that was having an impact.
Yeah, no, I'm just trying to kind of gauge, everybody's like, well, what's going to happen? What should I do? Should I buy? Should I sell? And I think just like trying to look and forecast, it's always hard to forecast, more than 3, 4, 6 months out. But I think like the clear picture, I think over the next 2 to 3 months is a continuation of, very weak sales here in the dog days of summer. And same thing with new listings. And if you actually look at like new listings here in the month of June, they were actually down on a year-over-year basis. So everybody likes to talk about the analogy of, rates are up, the housing market's, sinking. Everyone's going to start flooding the market. We're trying to unload all these homes. And that's just not what we're seeing. We're not seeing a flood of new listings. What we're seeing is just very, very weak demand, which is allowing kind of old, stale inventory to basically accumulate. And that's allowing the inventory base to slowly build. But yeah, in terms of new listings, they've actually been down on an annual basis for the last few months.
And John, I think that's the trend we were seeing last month as well in Toronto, the sales dropping very quickly, but listings also remaining down. Is that, I know you tweeted on July 4th, just yesterday, can anyone spot the trend? So it looks like weekly average sales prices as well are going down up for low-rise houses. Can you talk a bit about what you're seeing in Toronto around all those numbers?
Yeah, I mean, a lot of the trends, interestingly enough, that Steve talked about in Vancouver, very, very similar in the GTA. I mean, June in the GTA was, again, like the second month in a row that we've had the lowest sales volumes in 20 years. So not since like 2000, roughly. And to Steve's point, I mean, obviously, or obviously a much bigger city now, there's more inventory. Like when you actually kind of like, it's a massive to be down at a 20-year low. And it shows you how soft sales are. And similar to Vancouver that Steve touched on, which I find interesting, is that we're not seeing this flood of new listings. I mean, new listings here, I think, are a little bit relative to last year. I mean, kind of the same level, but down compared to historical norms for May, right? And to me, that's really interesting because usually as the market turns, people, if you think about the psychology of the market, when prices are going up, it kind of pulls buyers in because of this fear of missing out, and they jump in, and that kind of accelerates the prices up. Usually when prices start falling, it kind of does the opposite, where it pulls sellers into the market sooner, whether they're investors or someone who's maybe planning on selling 6 or 9 months from now decides to sell sooner to avoid the price decline. That's usually what happens, but that's not happening right now. It's like everyone's just holding, and like sale listings are soft, and a lot like what Steve said, it's like a lot of stale inventory selling. A lot of the new listings, interestingly enough, are like homes that sold in April that didn't close and are being relisted now, and are selling for less than what the sellers, what the previous buyers had paid for them. So it's a super interesting market. I mean, and yeah, the chart that you kind of mentioned, I post on Twitter, is basically like if we look at weekly stats for average prices, I mean, it's been like a straight line down since I think the end of February, where prices for low-rise homes peaked at like 1.7. And now, like end of June, we're down to like the mid 1.3s, which is, it's a massive decline. It's like, I think it's over 20% right now. So yeah.
Sorry, John, go ahead. Finish up.
Yeah, I mean, and I think as Steve kind of talks about, I do think we're going to continue to see a sluggish summer. I mean, even in a normal market, most active buyers hit pause July and August. Like that's just normally what people do. It's like they've been looking in the spring, they hit pause, they come back in September. But now we have obviously not just sort of that summer trend, but we have interest rates. And a lot of people hitting pause, wondering what's going to happen in the fall. But I do think we'll probably see some demand pick up. Like it's not going to be a seller's market, but I do think people are going to we're going to see people re-enter in September. A lot of people have been waiting to see what happens in the fall, but will probably enter in the fall.
Well, yeah, just going to say the one thing I like about the show is like the ability to sort of like filter through the noise and like really unpack like the data to figure out like what's going on, and which is like, John, it sounds like similar to like what's happening here in Vancouver. Like if you actually look, so if you look at Greater Vancouver, inventory is actually down on a year-over-year basis. It's actually dropped 13% from last June. So inventory is actually down. But what's happening is if you look at months of inventory, which again takes basically sales divided by the inventory, it's actually building. So you went from about 2 months of inventory for sale at the start of the year to now we're at just over 4. So, and it's basically just on weak sales. The actual number of homes that are listed and on the market is actually lower than last year, because demand is so weak. The months of inventory is actually quite high at 4.
Yeah, that's actually interesting.
Yeah, and we talked about how months of inventory tends to be a bit higher in Vancouver, but you are now starting to see it climb. John, we are noticing something a bit strange in Toronto, like considering how much sales have slowed. Talk about the inventory numbers.
So months of inventory have been trending up, but to kind of like to Steve's point, so technically we are up over last year, but inventory is still quite low compared to historical norms. So last year, I think low rise, we just had 6,000 listings on the market. Now we're about 9,000. So it's definitely up. But, if we kind of roll back to 2019 and 2018, we would normally have like 13 or 14,000 active listings in June. So the inventory is still relatively tight, at least for condominiums. When we look at, for low rise, when we look at condos, that's kind of where we're actually seeing, an increase in kind of a decent increase in inventory in active listings. And that's kind of the segment where even the months of inventory is rising a lot faster. But in the low rise market, we still only have like 2 months of inventory, which is still kind of a pretty tight market, right? So it's not like there's so many homes on the market. And that's what a lot of buyers are finding. Like, it's not like there's a ton of active listings. It's still a pretty tight market.
That's the number that I found so astounding. Like, for considering the sales dropping, the prices, to hear that there's just 2 months of inventory still is sort of surprising. And it looks like that low listing level, people not flooding in, people not jumping in, maybe waiting things out, is part of the story. John, you touched on relistings. What is your sense of how much of a problem that could be? So you're talking about people that were not able to conclude deals, or what's the story there? Why are they relisting now?
Okay, I think when we think about relistings, there's two things that I think are skewing our new listings count up, and they're actually probably lower if we take this into account. The first is a lot of homes are taking longer to sell. So what happens when they take longer to sell? Someone will list it on June 1st for 1.5 million, doesn't sell. They relist it for 100,000 less on June 14th, doesn't move. They relist it again a week later for 1.3. That's like 3 listings for the same home within the span of 1 month, right? So that's one thing that's kind of actually making our new listings count higher. If we think about kind of unique homes, like normally we would not see that level of new listings. The other thing, of course, is kind of what we touched on, which is there are, I don't want to say thousands, there are a lot of homes that sold in March or April that buyers didn't close on. They couldn't get financing, they backed out, the price fell, maybe they paid 1.5 million and the bank said it's only worth 1.3 now. You got to come up with 200,000 in cash to cover the difference. And a lot of homes are being relisted now for that reason. And that's kind of, again, another unique dynamic with this market. When prices fall that rapidly, that's kind of when buyers back out of deals because they can't get financing because the bank comes in and says it's not worth what you paid for it.
Wow. So that's a number like we should be tracking a bit, right? It's probably a small section of the market, but it sounds like there's some vulnerability there.
Yeah, definitely. And a lot of lawyers say they're kind of dealing with this real time. So we probably even haven't seen the full effect on the MLS in terms of the number of homes that have been failed transactions. But I'm going to try to quantify that in the future, the next couple of months.
It's funny that I haven't really seen that here in Vancouver. It's funny that you guys keep talking about that in Toronto, but I haven't really seen much or heard a whole lot of that here.
That's interesting. I mean, it's good because it's terrible for buyers. I mean, like you feel for like the buyers not only lose that money, but they don't even have anything after. Like, at least if you close, you're out that 200 grand, but you have an asset that will hopefully appreciate, right? So it's terrible for buyers when they can't close.
Yes, let's keep an eye on that for sure, because that does sounds troubling. So our big topic now for the surprise for this episode is rate hikes again. There was a little bit less news this week precisely, but we are now, many commenters are expecting the Bank of Canada to raise 0.75 of a percentage point later in July. I believe that's expected. That would be a huge rate hike. That is, I'm going to call it a monster hike, the highest since January 1983. I like to calculate that I was 5 years old then, because I like to orient the entire world around me as a heuristic. So that is to presumably fight inflation, which continues to rocket. So it reached 7.7% in May. That was higher than market expectations. And of course, the pressure continues to come from high prices in transportation, energy, gas, food, and shelter. So people are expecting this monster hike to come. The US counterparts, Bank of Canada's US counterparts already did the equivalent rate hike in June, which was their biggest increase since 1994 when I was in grade 8, in case anyone cares. No, grade 10, sorry. So the big question, Steve, I'll start with you. What do you think the July rate hike will end up being? And how do you think rates how high do you think they might go by the end of this year?
Well, yeah, I mean, I guess, my early call this year has been wrong. So maybe I'm not the right person to ask. No, but I think like as you said, it's always like, if rates go up, things blow up. And so I think we're already seeing that, John and I remember talking about this, on Yahoo 12 months ago, right? Which is like last time rates got to 3.5%, we saw a 10+ year low in home sales. And now here they are, rates in the fours, even in the fives in some cases. And you have 20-year low in Toronto home sales and 22-year low in the Fraser Valley here in Vancouver. And so, I think that it's kind of playing out exactly as we expected. I think the market's already done the legwork for the Bank of Canada, which is that you will get a 75 basis point rate hike here on July 13th. I don't know, is that their last one? I think like there's so much talk now about like recession, slowdown. I think like what's also important to talk about, and I know everyone's going to get all, disgruntled the fact that the Bank of Canada might get stopped out at 2.5%. But I don't know. Let's see. I think things are kind of starting to blow up as we're starting to see. But the one thing that I've found quite interesting is because when the whole market's on like one side of the boat, which is like rates are going up and they're going to keep going up, and it's the end of these low interest rate environment. When everybody's on one side of the boat, I mean, it makes me a little bit nervous. And so I think what's interesting to see is over the last 2 weeks, John, I'm sure you probably watched this too, is like, the Canada 5-year bond yield, which everybody's been watching, which again, prices your 5-year fixed rate mortgage in Canada. That's come off 50 basis points in 2 weeks. So the market, I think, is starting to price in that recession. And I mean, a 50 basis point move in the bond market in 2 weeks is not a normal move. So I don't know, is that the top that we've seen? Have we seen the peak in Canada 5-year fixed rate mortgages for this cycle? I don't know, maybe. That looks to be like the market might be pricing in. So that's kind of my views on rates. It looks like obviously, your shorter term variable rates will go up here at the Bank of Canada later this month. And it looks like your 5-year fixed rate maybe has peaked out.
John, your thoughts on what might happen?
I tend to agree with Steve. I mean, we're kind of I think we're on the same page with this stuff. I mean, yeah, for sure, 3/4 of a point. I mean, and it's tough to say if they're going to continue hiking. I mean, at the end of the day, I think they're going to they might do a small increase after that, but this is a huge increase in a short period of time. So I don't know if they're going to hit 3% the way a lot of economists are arguing they're going to hit. And I agree with Steve. I mean, I think it looks like the market's obviously pricing in a recession, pricing in potentially cuts next year. Interestingly enough,
three cuts next year.
Yeah. So and again, I mean, obviously the market's not always right, but that's what it's looking like. And I mean, I think it's going to be. I think for us, for the people on the ground who are kind of watching this, I think it's important to think about how this impacts, obviously, the economy and potentially the housing market, because, the thing that's kind of the disaster scenario for the housing market is if high inflation stays with us and high rates stay with us for a long time, right? Like, so kind of what Steve talked about, bond yields falling. Well, it would have been terrible if they didn't, because it's kind of like everyone's pricing in that inflation is going to be with us for a long time and there is going to be no rate kind of cut in the future, right? Whereas when you see kind of yields falling, it suggests that we might see some of these cuts in the future. And perhaps, I mean, a lot of macro people I follow think inflation may even be peaking soon, which again is like, supportive of the economy. I don't think we're going to hit a soft landing, but we'll maybe we'll touch on that because I think our finance minister is pretty confident we can.
Well, so, yeah, I mean, I think that, sorry to interrupt, but I think that's like the one thing, because everyone's like, oh yeah, you're just saying rates are going to go down because, you guys are trying to pump the housing market or something. Like, listen, I think like what's important to contextualize is like, but to move in your 5-year bond yield, it's like, okay, so maybe your mortgage rates come from, let's say, 5.2% today to maybe they drop back down to 4%. But like, I think even having 5-year mortgages in Canada at 4%, I mean, that's still going to be a tough adjustment for a lot of people, right? Like a lot of people that are renewing their mortgages are coming up, at old rates of 2.5% and renewing at 4%. Like, yeah, maybe we're in the next 2, 3, 4, 5 years, 6 years of low to no growth in Canadian housing markets. Like that's an adjustment phase for a lot of people. So I think just because rates are coming down, it's like what levels do they come down to? I mean, I think that's the question mark.
Yeah, I agree with you, and I think it's of course not bullish, but I think I think if they come down a little bit, in a 4%, I mean, I think we potentially avoid this sort of disaster, because I think obviously that if they stayed 5% for a year and a half, things would probably be pretty bad.
Yeah, I would agree.
So there's two basic reasons why people like the thoughts are around interest rates coming down later. One might be, hopefully, the best news story is that inflation comes down, and so that rates, the rate hike the hiking can ease off. The second reason, though, is that these rate hikes themselves could trigger us into a recession. This touches, which would then necessitate responses again in terms of cutting the interest rate to try and deal with it. So this again touches on what you were talking about, John, where our finance minister, Chrystia Freeland, recently talked about a soft landing coming out of in her words, COVID recession is, and again, her words, absolutely possible for Canada. So that sounded very soothing when I heard it. However, looking at a new study by the Canadian Centre for Policy Alternatives, a senior economist, David McDonald, there reminds us through a lot of interesting charts that the Bank of Canada has had, quote, a 0% success rate of quickly raising interest rates without causing a recession. There is simply no historical precedent for the Bank of Canada engineering a soft landing. And every time the Bank of Canada has attempted such engineering through rapid interest rate hikes, which it appears to be set on doing now, it has resulted in a crash landing, according to McDonald. So there's obviously something there that we'll be needing to look at and keep a strong eye on. We're going to show some of Dave McDonald's charts as well. He tweeted a very interesting chart around the correlations, or obviously maybe not correlated, but the trends of Canada's Bank of Canada interest rates rising and then being followed by recessions. So that was a really interesting take. Did you see that, John? Steve, any comments?
I mean,
John,
listen, do you want to start, Steve?
No, you go ahead. I'll chime in after.
I mean, listen, I think the odds of recession are, I mean, of course, quite high. I mean, I think everyone's expecting that. I mean, from my perspective, I mean, I think that, are we going to have a mild recession, or is it going to be a deep one? I mean, and what's interesting is a lot of the people, kind of non-economists I hear, I mean, almost people in the real estate industry seem to think it's going to be deep and long, like almost what Toronto experienced in the 90s, where prices plummeted for 2 or 3 years, and it takes 10 years for prices to recover. Like a lot of people, there's a lot of pessimism, and it's really interesting that it's coming from, I find a lot in our industry. I think that's unlikely. Again, I mean, it's possible if inflation stays with us for 3 years and, rates stay high, but I think that the deep recession's unlikely. We'll probably hit a mild recession, and rates might drop a little bit. But I think, kind of touching on what Steve said, even if it's just a mild recession and rates are at 4%, that's still very hard for the housing markets to adjust. So, I don't know if you see flat growth or negative growth or what, but it's going to take some time for the market to adjust to even 4% mortgage, 5-year mortgage rates.
Yeah, I mean, I just think, you pointed out at the beginning of the show, I mean, when you have your largest, metropolitan city having a 20-year low in home sales in the GTA, and knowing that, as our buddy Ben Rabideau points out, over the past 5 years, 85% of real GDP growth in Canada has come from housing and consumption. I mean, those are one and the same thing. So when you have 20-year lows, in your most important sector of the economy, I think it's inevitable. If you're not already in a recession, you're going to have one. It's just a matter of how long and how deep that recession is going to be. So I think again, it's the same thing. If you even look at CPI inflation data, the policymakers are using their best to make these judgments. I think that's a lagging indicator. I think it's imperfect data. Clearly we've been lagging the US. I know our finance minister was touting how, we had the lowest inflation in the G7. as if that was some sort of success. And now we're obviously playing catch up as inflation runs up to 7-8% here. So I don't know. That's kind of my thoughts. I think it's inevitable that we're going to be in one. It's just a matter of when that officially gets like recorded as one.
Yeah, maybe that's something we can look at, because I think people are worried, John. You talked about some of the negativity. If you have memories of the 1990s, I have family directly impacted by that turn in that housing market. It was really distressing. And so I think that uneasiness, which we haven't seen in our markets for a very long time, is maybe the reason why there is so much of that pessimism. I think it's worth maybe for a future conversation looking at what was the run up in home prices then, and how do things look a little different here? Because one thing I do notice, there's been like a slower, over 20 years, I think, run up this time with the house prices. So does that make a difference? Sure. As that's something that maybe we can look a bit into in our next conversation.
Yeah, I mean, and employment's a big thing. I mean, and a lot of economists have touched on this. I mean, the fact that we're kind of like at record, like historic lows in terms of unemployment rate. I mean, to have these massive adjustments and crashes, like usually they're coupled with a higher unemployment rate. You know what I mean? Like, but again, we'll see.
I think it matters too of like, what you buy and when you buy it, right? I mean, there's lots of, I can point you to tons of product in Metro Vancouver here that, if you bought in 2016, 17, near the top of the market, like you're still not making it. You still haven't made any money despite this huge bull market that we've had over the last 2 years. So, and again, I think, hey, if you bought in February of 2022, like, yeah, we might fast forward the clock here in 5 years and say, hey, listen, you still haven't made any money. So I think it just depends on what you bought and when you bought it. I mean, yeah, John, you probably know, like if you bought in some of these suburban GTA markets at the top of the market, you could be sitting on them for minimum 5 years.
Yeah.
Yeah, it definitely seems, and that's the question, is there is going to be pain, and it's the question is how much of the market is involved in that, and I think that's something that will be really good to look at. All right, so that was very cheerful. Now we're going to turn to another completely unsolvable problem, supply, or seemingly unsolvable problem. CMHC just released a new report this month, in which they attempted to quantify how many new homes would have to be built in Canada so that housing prices could become more affordable. And I think they define that as falling 30%, at least in major centers like Toronto and Vancouver. So they project that if current rates of new construction continue, the housing stock will increase to close to 19 million housing units by 2030. To restore affordability, though, they project that Canada will need an additional 3.5 million units. 2/3 of those 3.5 million units represents a gap that is in Ontario and British Columbia. So it's concentrated there where housing markets are least affordable. So that was another big number that was thrown out. I did enjoy, and we'll put up here, a tweet from Professor Mike Moffat, who then stated, I don't think people realize how wildly ambitious these targets are. So he points to Ontario's housing targets and has a really neat chart here, which shows in that yellow what the CMHC's number would be. And then in the gray, what the Ontario government's target is apparently, which is 1.5 million units. And then the blue line underneath shows us what we've actually built over the last 10 years, which has never really come up past 600 units, 600,000 units per year. So not very encouraging. The words pie in the sky come to mind. John, comments on that?
Well, I mean, yeah, it's obviously, I don't even know what kind of, CMHC publishes these reports. I mean, suggesting this is a solution, but we know it's impossible. Like you cannot scale housing completions that quickly. Especially overnight in that scale. Like you have to, they're expecting Toronto to build 4 times as many homes as we've ever built in the past. I mean, that's just obviously not possible. And I mean, and this kind of makes me feel like, I don't want to say bullish real estate, because obviously we're in a bearish market right now. But, if we think 10 years from now, like longer term, there are still these, and I think that's why most economists are not as bearish, you know what I mean? And interestingly enough, most real estate people are more bearish is what I find, because there's still these fundamental pressures. I mean, our population is growing way more rapidly than our ability to build housing. And at some point, you know, my feeling is that people who are going to kind of set the floor on housing in the GTA are going to be investors. It's going to be investors who see value, like, you know, they're going to see value. They're going to see value at some price, and they're going to start jumping in before, like in scale. Obviously, there's still buyers out there, but in bigger numbers, the growth in investor demand is almost going to set a floor, because people are going to say, I don't care what's going on. Like, we're not building enough homes. There's obviously upward pressure on prices over the next 10 years. So,
yeah. So you're talking, short term versus long term, right?
Yeah,
so
exactly. Short term, we're going to see some pressure in the market, but at some point, you're going to see this acceleration probably as investors look to capitalize, because they're going to say, listen, they're not solving anything. We're
returning to the problem.
We're going to have this same problem 3 years from now, 4 years from now, 5 years from now. That's my instinct. I don't know what Steve thinks.
Any thoughts on what you're seeing there?
I mean, I don't know why like CMHC just, you know, wastes taxpayer dollars with, I don't know, all these smart PhDs that it's like, it's kind of like you can kind of sit there and pontificate and run all these models and stuff. And then you have that, and then you have like the real world, which is like, if you actually like, have you ever built anything? Have you ever chatted with developers? Have you like, so I look at the market today, and when John says, hey, we have a 20-year low in home sales, like, I'm sorry, but like no developer is like, oh gosh, well, this is a great time to like launch a new product. Like, they're all like, not all of them, but like a lot of developers now are hitting pause. And it's because like, this is not a charity, this is a business. Like, they have investors, they have shareholders, and not only that, but like the people that are financing the cost of these builds. I mean, we're talking 10, 20, 40, $50 million to build some of these projects. The banks don't want to lend money if they think the outlook is negative, and say, hey, listen, like, you know, prices are sliding 5-10%, sales are at 20-year lows. Like, do we really want to finance this project? And I know, because I've chatted with some of these large financiers, that they don't want to lend right now. The risk reward is not there. So when CMHC comes out, and if you read the report, they say, well, you know, someone asked, well, what happens if you hit your $3.5 million additional units in new housing? And they said, well, if we actually do hit our target, which is obviously not going to happen, let's just make a hypothetical and say that they do hit their target. They say that home prices in BC and Ontario will drop by about, give or take, 30% by the year 2030. Well, it's like, which developer and which banks are going to be lending in an environment where house prices are down 15, 20, 25, 30%? Like, no developer is launching in that market. They can't. Like, think about it, like if you were just like a private investor and you have your own money, and it's like, I'm building a high-rise tower, and I'm like, hey, John, you want to invest with me? Like, can you give me $500,000 and put it into my project? I know prices are down 20%, but don't worry, they're only going to drop another 10. So, but you know, it's like, why does nobody want to invest in big tech right now? All these like startups, because it's like the market's getting obliterated, stock prices are down, and capital's drying up. So it's the same thing on real estate. Like, and so I think like that's another element I think that CMHC is kind of missing, is that you have to have the right market conditions as well for developers to want to build.
Yeah, a lot of numbers running counter to each other. That's clear. And John, you, just to conclude on this, you mentioned that a high inflation, high interest rate environment would be obviously have a lot of impact on the housing market. And I would think for new construction, even more so, that they're getting hit both on the cost of construction and getting financing, and maybe even unable to complete some of the things that, you know, people thought would be in the pipeline. So in the short term, this actually supply issue could be getting a bit worse.
Well, yeah, I mean, some projects are getting canceled. Some, like Steve said, aren't launching because costs are so high, financing is so high, prices are down, and the developers don't want to drop their prices. You know, and obviously CMHC doesn't factor in what kind of inflationary pressure does this have on construction. If you're scaling up and building 4 times as many, even if you doubled, you got to think about it's going to drive costs up. But again, these are built, like, these models are built in this utopia perhaps where you can just scale up your completions without having any impact on labor prices, construction costs, or anything, right? So these are not, solutions for the real world, like Steve said. It's kind of,
I think the one thing that's interesting is in Canada, right? Like I don't even know how many do we have? How many publicly traded like real estate developers do we have?
I don't know if we have that many. Yeah, you're right.
Very, very few compared to like the US, right? So
Yeah.
like you have to think it was like a lot of the capital that is like being poured into like development in Canada is like it's private money, right? It's like it's money that's looking for return. And so it's all about like the risk reward. And I mean, if you're trying to raise money for like your development project, like you have to have a good pitch, right? And so it's a lot easier to make that pitch in a bull market where prices are going up and everybody's optimistic and feeling good about housing and what your return's going to be. And hey, by the time the project's built in 3 years, prices will probably be up even more. It's a lot harder to raise money when again sentiment is negative. You have a 20-year low on home sales, prices are down 10%, and everybody thinks they're going lower. It's very hard to attract capital into that space. And so that will naturally throttle a lot of new housing supply. So, to John's earlier point, like structurally, I think that still is a bullish argument for the Canadian housing market. Again, not to say that, the bear market is over, but I think structurally, if you look at it, like there is this mismatch that I think is going to be here for quite some time.
Mm-hmm.
So lots to consider. I have one more topic, but I want to leave us a little bit of time for questions. So I'm going to ask you guys each for a one-word answer to the news that the UK is, one-word response, I should say, to the news that the UK is considering introducing 50-year mortgages. So mortgages that could even be inherited by the next generation in the household. John?
Possible, not quite 50 years, but possible 30 or 35 if high rates stay with us and the market tanks. I think it's possible that the federal government will do that to support housing if they can't lower rates to support the housing market. I think it's 100% possible.
Steve?
I think that housing is still the single most important social and political asset class in the world. And don't count on policymakers to do the right thing. Count on them to do what it takes for them to get reelected. And so I think I think it's not a free market in housing. Let's put it that way.
Mm-hmm.
Yeah. And just a reminder that we used to see 30. So John, now 40. We're at 25.
We had 40-year mortgages.
Yeah, we had 40 at one point. So there could be a return to that.
I think prices would have to get down though, like a decent amount for that pain to set in.
I agree.
Could be wrong, but.
All right, so we'll track that as well. All right, let's get to our questions. So from Twitter, from AG Chennai, question for John on the skyrocketing rents in the GTA. Is this because of demand from potential buyers holding off in this cooling market, or are owners passing mortgage servicing costs on to renters?
That's a good question. Okay, so number one, landlords can't pass costs on to renters that easily. Like rents are set by the market. I can't just arbitrarily decide to charge $200 a month more than everybody else because my costs are higher. Like this is a misconception some people have. It's that doesn't work like that, right? Rents are high because there's too much demand and not enough inventory. And it's really driven by a number of things. A lot of buyers who are hitting pause don't want to buy a home. Some of them just need somewhere to live, so they're renting instead. So that's one thing. We're seeing a return from people going to school. So the market's quite busy now from an increase in students who plan to return in September. And we're also seeing a lot of people relocating here. Like one of our agents said her last 3 rental listings were rented by families relocating from Ukraine and Russia. So I think there's like a lot of dynamics that are kind of causing rents to increase. I mean, and I just tweeted the other day, they're up. Condo rents are up like over 20% year over year, which is massive.
And Steve, I like this next question for you from @EugeneYVR. What would the psychological impact, do you think, on the real estate market be in the event of a 75 basis point interest rate hike in July versus, let's say, a slightly smaller one at 50 basis points?
I mean, I think either way, 50 or 75 basis points, I still think it hurts demand. I think most people, like if you really think about it, I think that let's be honest, 98% of Canadians don't know who Tiff Macklem is. And a lot of people do not know what the Bank of Canada does. I just don't think there's more interesting things for people to, to focus on. And so I think what they're going to do is they're just going to pick up, the news headline at CBC or the Globe and Mail. They're going to read interest rates going up, whether that's 50 or 75 basis points. That's the headline they're going to read. And that's going to play into the sentiment and psychology. So I think either way, in the short term here, I think that whatever the Bank of Canada does in July will impact sentiment.
And John, there's a interesting question from @JusticeQueen6. I think one of the questions that everybody kind of thinks about: how much will home prices need to drop to even make them affordable? Right now, with the rates, it is still very expensive for buyers. And I think the CMHC was saying like there's a 30% drop would make things affordable. Like, do you have a sense of what that number is?
I mean, it depends on how you define affordable. Like at the end of the day, if you define affordability as price to income, then technically homes are more affordable because prices are falling. I mean, we're down probably 20% in the suburbs, right? But in terms of what you can afford to buy, and I think this is what she's getting at. Like when we look at our actual mortgage payment, because our interest rates are say 5% versus 2% a year ago, I mean, you can pretty much afford the same home today as you could a year ago. The only difference is a year ago you were paying 1.5 million for it. Today you're paying 1.25, but you're paying a much higher interest rate. Your mortgage payment's the same, but you have $250,000 less in debt, right? So this idea that home prices are going to fall and I'm going to be able to get so much more home, I don't know when that's going to happen. I don't think Toronto is going to be like affordable by any traditional sense anytime soon for the reasons we discussed, because we're growing too quickly. So I don't think it's about waiting for this ideal affordability number. Like at the end of the day, if you're a home buyer, you got to look at the market, decide when the right time is to move in. Some buyers are jumping in because we have clients who couldn't afford 4 months ago and they need a home for their family. And rather than when all of a sudden prices decline and they could afford a home, and they decided to jump in, and they know prices might fall a little further, but they're thinking, I'm going to be there for 10 years. I don't really care. So I think for buyers, they just need to decide when the time's right for them rather than trying to find this ideal bottom when things are affordable, because I don't think that's going to happen. No matter what the bottom is, it's still going to be very expensive.
And I think we have actually a lot of great questions. I might hold some of these for our next conversation. A lot of great ones around rental yields and pre-construction. So I'm going to hold them over to next conversation, if that sounds good to you. Yeah. Both. And maybe just end with one question here, which I thought was very interesting. All right, so I'm going to end with this one again from AG Chennai. At AG Chennai, I think sellers over the next 5 years will bite the bullet and not sell their house for a loss. And that applies mainly to those who bought homes in the last 2 years. With high rates or neutral rates, do you think this will cause Canadian real estate prices to stay flat or crash further like Japan's in the 90s?
John, you want to start?
Am I starting? I mean, this is a hard question. Listen, I mean, certainly anyone who bought in the past couple of years, I mean, they're not going to sell for a loss if they don't have to sell. Like, people sell for a loss if they needs to move or if they're pressured to sell. But I think what we're finding and what I'm seeing on the ground is that there's a couple of things. Number one, even like a lot of clients we have who needs to sell, if they can't sell, they'll like work with family to try to keep their property rather than sell at a huge loss. You know what I mean? Like, some people are adjusting to the market, but they have their own mental floor. But beyond that, there are a lot of households that are holding real estate, right? And they're just keeping it as an asset. They're moving out of the province. They're holding on. This is one of the reasons why new listings aren't surging, because people are holding on to their real estate for the long term. And I do think that's going to bring some stability, probably, because again, prices often crash when you have this massive flood of new listings, right? And we haven't seen that. And I think the reason they're crashing right now is because, again, we've talked about this in the past, even though there's not a ton of new listings, demand has been destroyed. And a lot of people got locked into these transactions where they bought and they needed to sell, and they're effectively distressed sellers, right? And it'll be interesting to see what that looks like in the fall. I think we're going to see less of that. But again, it depends on how low demand is, right? And how eager some sellers are.
Actually, John, that touches on a question that at Justice Queen 6 also asked. Are you seeing a lot of desperate sellers right now? Or are you suggesting you're seeing a few and you suspect there might be more in the fall, or we need to see what shakes out?
I think there are fewer now because I think you see fewer people buying and then listing their property, right? So the people who are listing now either don't need to sell it so they can close on their next home without selling it, or they're selling first and then buying. So I think there's fewer of these desperate sellers right now, personally.
And Steve, your thoughts on the longer term?
Yeah, no, I mean, to John's point quickly there I think it's the same point. It's like this initial like flush that we've seen, right? Which is like the very sharp 10 to 15% correction that we've seen in parts of the market over the last 3-4 months, I think has been those people that got caught offside with having one too many properties, purchasing something and then not having sold their existing one. I think we're kind of working through that now. So I think the probably the decline, in my opinion, if it continues, will be a lot more gradual. But to the earlier question regarding like people not wanting to sell because prices are down, like I think it's important to understand like there's always a reason for people selling. It's never like nobody's like, oh, I'm going to sell because prices are down, or I'm not going to, like, it's people sell because like, okay, you got a divorce, there's an estate sale, somebody passed away, you have cash flow issues, you just lost your job, you're relocating, like things happen in people's lives where like they are ultimately prompted to sell. And most people that I know, like, so when you go back to like always like frame back like what happened in the great financial crisis, right? Like it's like, well, why didn't people just hold on, right? Like who cares if values drop 20-30% in some of these states? Why sell? Well, it's because it was a cash flow problem. They didn't, they lost jobs, the renters moved out, the new rents didn't cover the cost, the mortgage interest went up. Like people don't sell because equity drops. People sell because there's cash flow constraints. So I think that's kind of important to contextualize.
Yeah, there was actually a great interesting piece in the Toronto Star, I think by Tess Kalinowski, around how Canadians tend not to walk away from homes or forced to sell even at losses relative to Americans, which is worth checking out. And a number of
like they'll definitely try to hold on as long as possible, right? I mean, anyone will, especially if it's your primary residence. You kind of scrap together and you cut everywhere else that you can in order to sort of service your mortgage. But like I said, I think like people that John, like you've seen this, right? If you look at like where we'll start to see, I think like the next sort of interesting thing to watch is like, when do we start to see like the distressed foreclosure sales, right? Like where, hey, you took on a private mortgage at, on a 1-year term at 5% a year ago. And now when you go to renew, it's going to be 8%. And your initial plan was to be able to refinance at a traditional lender. Like those people are then going to be forced into a foreclosure sale, not because their equity is down, but because they simply can't afford, like the cash flow, there's a cash flow problem. And so that's kind of something I think is the next thing to watch. And that's probably at least 12 months out.
Yeah, we'll definitely keep an eye on that, because I know there's even specific areas in Toronto and Vancouver that, that may become an issue. So yes, definitely. Let's keep an eye on that. So I think that's our time. I don't want to make this too long. I know we did go a little bit over, but there's a lot to discuss. So I encourage everyone, thank you for watching. Also keep emailing us your questions, comments, and we will definitely respond. And I'm already going to think about some grouping, some themes, around some of these questions that we're getting for our next conversation. So thanks to both of you.
Awesome. Yeah. Thanks again.